Adam, what is your take on today's inflation print and what it means for the Bank of Canada and ultimately the Canadian dollar?
Yeah, and even I'd extend that to the global inflation picture as well. The Bank of Canada was the first to hike. And, now we're seeing some fruits of that labor, and we've seen inflation maybe start to show some signs of topping here. It was flat on the monthly readings or down, even on the core side. So there's a lot to like here if you're the Bank of Canada. Now you have to ask yourself the question, okay, is it time to start slowing down or signaling a pause? And that's the reason the Canadian dollar is softening, is we're seeing this idea that there will be some space between the Federal Reserve and the Bank of Canada on that terminal top in interest rates.
One of your brethren, if I could use that term, another Forex specialist, this is Mazen Issa at TD Securities, wrote yesterday that there was, quote, nothing to like about the Canadian dollar at this juncture. What he means to say is, of course, that he sees it weakening, and I think weakening significantly is his call against the U.S. dollar, and a lot of that has to do, of course, with the expected path of rate hikes from the U.S. Fed south of the border and the Bank of Canada north of the border. What's your take?
Well, the market is shifting right now from a worry about inflation to a worry about recession, to over-tightening. And we're kind of at that nexus right now where the market's saying, listen, if the Fed goes hard tomorrow and the ECB is forced to hike a lot more because we're getting very high inflation numbers out of there, that we're in a really tough spot in the global economy, China with COVID-0 as well. And Canada is really a play on the strength of the global economy and the Canadian dollar by extension. So if you think that we're about to turn much lower, the Canadian dollar is absolutely not the place to be. And that's something we've been saying all year. At the same time, Canada is still much healthier than a lot of the alternatives. So I think we get to a bottom sooner, but the risks are growing that we overshoot to the downside in both the loonie and the global economy.
Another thing we hear more and more frequently from foreign exchange experts is that the Bank of Canada, while it may not acknowledge so explicitly, has got to pay attention to household debt levels in Canada and what significantly higher rates from here would mean to household debt in Canada. Do you agree?
Absolutely. I think people maybe don't understand the difference between the Canadian and the U.S. housing market. In the U.S., it's a 30-year fixed. So a lot of people who were getting mortgages last year, it was at 1.8%, and that's locked in for the life of the mortgage. Whereas in Canada, it's a 5-year fix, so you have resets, 20% of the market every year, and you have a lot of people on variable rates. So Bank of Canada rate hikes hit the bottom line of Canadians almost directly and much more quickly than what happens in the U.S. So the impact of rate hikes is a lot more intense in Canada, and I think the Bank of Canada is going to realize that and may even soon ease back off the hiking as soon as October and say, listen, we're going to take a pause here. We've done a lot of work, and that's true, and see how it shakes out from here. And, that is the kind of thing that will send the Canadian dollar lower. But then again, you have to wonder about the global economy and what kind of shape it's in here.
What about positive influences on the Canadian dollar? One of them is oil prices. While they are well off their peak, they are still, I think most people would characterize them as strong crude oil prices.
It's a very interesting market. The energy market right now is fascinating. We've seen demand come off a little bit in the market looking at that recession call for next year, but supply is also tight. OPEC is pumping much less than they promised, and we have the chance for Russia to cut off supplies in December, as well as the USSPR strategic reserves offering less starting in November as well. So, it's an interesting time for investment as well. We saw the bond market today is blowing up a little bit, and that's a big worry. We saw an LNG developer pull a bond offering today, and that speaks to the lack of investment in energy. Down the road, that will play into Canada's hand and the Canadian dollar's hand. But right now, the market is so focused on this year-ahead outlook for growth that it's getting increasingly hard to buy the Canadian dollar.
Let's finish with something that everybody will be talking about 24 hours from now, a little more than 24 hours from now. That's the Fed and its so-called dot plots release, which give a relatively nuanced view of where individual Fed governors see rates going over the next while.
Well, it's an interesting one because we're going to get the 2025 dot for the first time today. And the Fed is trying to play this game where they say we're going to hold rates high. We're going to hold it at the top end. But they're going to have to come out with the 2025 dot, and that's likely going to show a decline. So that may be seen as somewhat dovish by the market. We're also seeing a lot of kicking and screaming today in equities and in bonds, in a market playing a bit of a game of chicken with the Fed and saying, if you go hard and if you repeat the Jackson Hole sort of mantra and we believe it, then it could get really ugly here. So if there's any hint, I think, of dovishness, we can see a bit of a relief rally. Sentiment is so negative right now that I don't think it can get much worse, but you have to wait and see what they deliver.
Adam, thanks.